as you get more indebted, in theory, it should be deflationary, but that only holds up true until the central bank starts structurally monetizing it. And so, I mean, this past decade was not deflationary in the sense that you had pretty big deficits, you had a lot of those monetized, and then whether you look at asset prices going up or we look at consumer prices going up, it depends on where the money's flowing. We've had that more inflationary type of environment. And I think, while we're in this current window where the Fed has room to tighten and to reduce its balance sheet, I think the issue is that when you look out forward, the amount of treasury issuance that's coming to market, one of the Fed's kind of shadow mandates is to maintain some degree of financial stability in the system. And so should you get some sort of treasury malfunction, not insufficient buyers, insufficient liquidity, that kind of thing, I think eventually you would see the Fed step back in.
The global economy is grappling with a substantial debt issue, notably the escalating debt-to-GDP ratios across nations. Developed markets carry heavier debt loads compared to emerging markets on average. However, emerging markets often shoulder debts denominated in foreign currencies like the US dollar, adding complexity to the problem. This issue is pervasive worldwide, albeit with varying degrees of severity. In 2019, the International Monetary Fund reported that the collective global debt reached a staggering $180 trillion, surpassing 220% of the global GDP when accounting for both public and private debt. Notably, countries like the United States, China, and the Euro area share similar debt-to-GDP ratios, while Japan stands out with the highest such ratio. Recently, Treasury Secretary Janet Yellen commended the IRS's new initiative, anticipating a $2.6 trillion reduction in the federal deficit over the next decade. This move aligns with the Biden administration's commitment to deficit reduction through the Inflation Reduction Act. The IRS's innovative paperless processing program aims to streamline document handling, enabling digital submissions and significantly cutting storage costs. Amid these discussions, Lyn Alden of Lyn Alden Investment Strategy offers an alternative perspective, suggesting that concerns about an impending recession might be exaggerated, with the possibility of a milder economic downturn.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So I expect us to eventually see at least a mild recession. I don't know if it'll be this calendar year or next calendar year, but one thing I've been tracking throughout this, kind of spring and summertime is that, throughout 2022, so many people are focused on interest rates, whereas I think the deficit's not getting quite enough overall focus. So during 2022, we had a narrowing deficit in large part because taxes were much higher that year because they were based on 2021 capital gains and other economic impacts from that kind of boom year. So 2022 is this period where the fiscal expenditures were kind of winding down somewhat, and the tax revenue was winding up pretty well. And so that was kind of a contraction event. It was also Fed tightening. So most things were bad for the markets. Whereas this year, it's almost like we've gone far enough that now we actually have widening deficits again. So on one hand, obviously the COVID era types of stimulus have wound down, but we're still running these background structural 6 to 8% of GDP deficits. And then ironically, as they increase interest rates, they blow out that deficit. And so they put pressure on some areas of the economy, but then these other areas of the economy, wealthy retirees, basically like a bunch of different types of segments of the economy are still spending pretty aggressively. Now, it's when you look at manufacturing, when you look at the PMIs, when you look at most types of indicators, I think we still generally see deceleration towards a risk of a recession later this year or next year. But I expect it to be kind of mild and certain sectors to be in a recession, whereas others might not be because they're not equally affected. Either you can one metric you can look at is unemployment. So if you have a higher unemployment rate than the average recession, you'd be more in the severe recession camp, whereas if you were a lower unemployment rate than the average recession. An example would probably be the 2001 recession. So even though it was a very bad period for the stock market, by most indicators, the recession itself was mild. Another thing you can look at is year-over-year percent decline in real GDP. So in most recessions, that goes negative year-over-year. Whereas in the 2001 recession, for example, you actually pretty much just went down to flat year-over-year. So even though you did have a contraction in GDP, it wasn't severe enough to bring you down to where you were a full year ago. So there's different metrics you can look at to see exactly how deep the recession is. And I think one of the challenges, the past two recessions have been unusually deep. And so we're conditioned to think of recessions as these cataclysmic events, whereas they actually occur pretty regularly in history, and most of them are not as severe as the 2009 Great Recession or the 2020 lockdown recession. There are very few bond traders today that will change their opinion on U.S. Treasuries based on Fitch, their rating, right? So they're very like not a lot of entities say, oh, now that it's double A plus, we're going to treat them differently. So mechanicalistically, it shouldn't be a big deal. But I think it does reflect this kind of broader trend that we're on right now, which is that I think more and more participants over time are seeing the fiscal unsustainability that the government's going through. And so back in 2011, S&P did their downgrade that was based on a debt ceiling impasse. And back then there were four companies that were AAA. And now there's only two that are AAA, but it's still the case today that the U.S. government is now ranked behind two U.S. companies in terms of their likelihood of defaulting on you with their bonds. And I think that's actually somewhat reasonable. If we imagine the next 5 years or so, the chance that Microsoft or Johnson & Johnson misses an interest payment is actually probably lower than if there's some sort of process hiccup in Congress and they end up missing a payment or principal, something like that, at least temporarily. And for investors like us that might not hold these levered, it's not a big deal. I mean, if we have to wait 2 extra weeks to get our payment, we might not even consider that a default. But for example, if you're a levered bond fund or you're some other entity where you have liabilities and assets, and these are your assets, if you have a multi-week window of disclarity about when that bond's can be made whole, that matters. And I think that this is basically showing that there's more cracks in the system, there's less governance overall, and as the deficit's wide and as this kind of blows out, I think more and more people are seeing kind of the fiscal unsustainability, even if this particular downgrade doesn't actually matter for any fundamental purpose.
A convergence of favorable borrowing conditions alongside the gradual utilization of savings amassed during the pandemic has upheld spending resilience, even as pronounced inflation chips away at household earnings. The pool of existing consumer credit has swelled by $873 billion since hitting a low point in mid-2020, while the reservoir of household funds encompassing cash, checking, and time savings deposits has dwindled by $1.1 trillion between the initial quarter of 2022 and the opening quarter of 2023. These figures, drawn from the Federal Reserve's flow funds data, collectively amounting to $2 trillion, have played a pivotal role in averting an economic recession, countering the backdrop of the Federal Reserve's aggressive streak of interest rate hikes. Alden delves deeper into the discourse by shedding light on unsustainable debt thresholds and their reverberations across the global economic landscape. Now, let's return to the video.
When a country has debt denominated in its own currency, it's able to finance things with its own central bank as much as it wants. It's not that default's the issue, unless it has, again, some sort of policy, unless it kind of does it to itself, due to its own conflictedness. So default's not really the issue. It's more about structural inflation or waves of future inflation. So I would say what's unsustainable about it is that the past 40 years, you've had rising debt as a percentage of GDP in the public level, but that was offset by structurally falling interest rates. And the challenge going forward is that, even if interest rates aren't going up structurally anymore, if they're just going sideways from here or they're chopping in a big range, now you don't have that interest rates going down offset for the larger and larger structural deficits. And so now we're seeing them, I think, more directly, that basically as debt as a percentage of GDP keeps going, as our deficits very large relative to typical history, especially history outside of a recession, as those things keep inching up and as you have structurally higher interest rates, it basically shows that we're kind of stuck in almost like an emerging market type of situation where these deficits are going to keep piling out into the economy, and there's really no will from Congress to address them because they're more structural. They're not based on temporary COVID policies or things like that. They're Social Security, they're Medicare, they're military spending. These are the more structural kind of baked into the cake issues, and I think that's going to basically just pour out over the next 5, 10, 20 years. A couple of things can come of it. One is that Social Security could be means tested in the future. And so some people that think they're getting Social Security benefits might not get them because otherwise the whole program might become more structurally problematic in 2030. So you could see mean testing. The challenge right now is that raising taxes or cutting any of these programs is politically unpopular. And so the other way that they can manifest if there's no action on a lot of these different areas is that instead we just get above target inflation compared to what we're used to. So it doesn't mean every year is very high. For example, if you're in a recession or the Fed's tightening aggressively, you can still get a temporary down move in inflation. But I think that we would be in an environment in some ways like an emerging market where there's a background level of inflation that you start to become accustomed to that is higher. And I think that's the kind of world we're entering potentially in developed markets. So we had decades of structural trade deficits, and then that accumulated a deeply negative net international investment position. And if we were to start reversing that, if we were to have, say, a weak enough dollar, and we would have a significant enough trend change so we get back to kind of a period of structural trade surpluses or current account surpluses, we could start chipping away at that negative net international investment position. The other way to do it is if that which is unpleasant, is if U.S. Assets perform poorly for a long period of time, whereas international assets perform very well, then the value of Americans' international assets can appreciate faster than the value of the foreign sector's ownership of American assets. And so you can reduce the negativeness of the net international investment position that way. But I think this is going to be a long, multi-decade process to reverse that, which is similar to how we saw the United Kingdom over the past several decades. I think the United States is kind of following the path of the United Kingdom, which is you start as a global empire, then you shift more and more towards being a country that's, still very large and powerful economically, but that is not quite in the same status that was before. I think it's more likely that it'll be inflationary rather than other things will be cut specifically. Like I don't see Congress deciding we're going to cut military spending because our interest expense now exceeds military spending. I don't think that's the decision pathway to consider. But I do think that, especially when you run the numbers, even at the current interest rate, so just over 5%, as more and more existing debt refinances towards the current interest rate level, we would trend towards about 1.6 trillion in interest expense. So even this current 1 trillion level is it's only in the current environment where some of the debt has rolled over in this new interest rate environment. Basically, if we just maintain it for a period of time, this is going to trend structurally upward. And one way to think about it is that that's a negative for the US government, but it's a surplus for someone else, basically whoever owns future treasuries. And so there's more money pouring into the economy. And so certain insurance companies, certain banks that are not in trouble, certain retirees, certain bond funds, money's kind of pouring into the economy in this way, and it's somewhat stimulative. And that's how it leaks out in the form of inflation potentially.
The U.S. has hit a concerning milestone as credit card debt crosses the trillion-dollar mark for the first time in history. This alarming development indicates potential challenges ahead due to rising interest rates and potential difficulties in debt repayment. Current records show consumers owing a record $986 billion on their credit cards, up by 17% from the previous year. This data, sourced from the Federal Reserve Bank of New York, highlights a significant increase compared to both the start of 2023 and April 2021, during the pandemic. The surge in consumer debt during June, which expanded by $17.9 billion, is attributed to the Federal Reserve's credit tightening in response to a credit crunch caused by interest rate hikes. While debt linked to major purchases like homes and student loans increased, revolving credit like credit cards and lines of credit decreased slightly by 0.6%. This anomaly in revolving credit has raised interest among economists, potentially indicating some consumers nearing their credit limits, which might lead to a consumption slowdown in the latter part of the year. The escalating credit card interest rates, along with elevated mortgage rates and other interest-based financing, have surged as the Federal Reserve incrementally increased the interbank lending rate. The average credit card interest rate offered by commercial banks has surpassed 20%, up from 14.5% a year prior. This surge in rates is the highest ever recorded for a payment method known for being one of the costliest ways for consumers to make purchases. As the U.S. grapples with these trends, the question remains whether the nation will experience a mild or substantial recession in the near future. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.